We'll be going over IRS Form 8958, allocation of tax amounts between certain individuals in community property states. So this tax form is limited to only people that live in community property states. There are 9 community property states: Arizona, California, Idaho, Louisiana, Nevada, New Mexico, Texas, Washington, and Wisconsin. And also, so they have to be married filing separately, filing a separate return, because joint tax filers would simply put everything on one return. Or this form can be completed by people that are in a registered domestic partnership, or RDP. And there are 3 states that recognize RDPs. I believe that would be California, Wisconsin, and Nevada, I believe. Don't hold me to that, but that is, I believe that is the consensus for registered domestic partnerships. So when you're filing separate returns in a community property state, you have to recognize each of the income items, income, tax, deductions, credits, and you have to determine whether or not they're treated as community property, in which they're split equally, or if they're allocated to one spouse or partner or the other. And based on community property rules, some items, generally any income that is earned, for example, whether it's self-employment income or wage income by one partner in a community partner state or community property state, would be allocated in equal amounts to both partners. But then there are other situations in which separate item might be recognized because it's part of separately held property, or that spouse it's allocated to a specific spouse or partner for a separate reason. So we won't dive too deep into community property tax treatment. That's what IRS Publication 555 is available for. So if you're bored and restless and you want to go to sleep, you can pull out a copy of Publication 555 and you'll be asleep in no time. So this form that you can download from the IRS website, it's a fillable tax form, so you can actually use this in preparing your tax return. I don't believe that this was available on the IRS fillable forms site last year for the 2022 tax filing season, but they have updated it in November of 2023, and it is available in the free file system for the IRS. So we're going to go over kind of briefly the items of income. Just as a heads up, I am more than happy to research questions, but because each state has different tax treatment, I cannot promise that I can answer questions about every single situation. So as a blanket caveat to the broad audience, I'll do my best, but if I can't get a definitive answer from a source that I can cite, then don't be surprised if I refer you to your tax professional. So unless you're very in tune with community property rules in your state, you may consider hiring an accountant just to make sure that you're reporting everything properly, especially if you're filing separate tax returns. And one final thing, we will cover the difference between filing jointly and separate returns at the end of this video. And you should always consider running both joint and separate tax returns to determine which one is going to give you the bigger overall, or maybe the lowest overall tax bill between the two of you. In some cases with domestic partnerships, you don't really have much of a choice. Each partner has to file an individual return unless you are married. But for married couples, it is always prudent to compare a joint return to two separately filed returns, just so that you can understand whether one is going to give you a better tax bill than the other, and then to get a better understanding if this is a permanent situation for your, for ongoing years, or if this is a one-off and your separate tax treatment ends up being something that you take a look at the following year. So we'll talk a little bit about how separate returns can impact your tax credits and things of that nature. So let's start at the very top of the form. We've got both taxpayers, John Doe and Mary Doe. They live in Texas, which is a community property state. So we'll put their social security numbers at the top of the form. And then you'll notice that there are 3 columns: column A, column B, and column C. And we simply put column B is, in this case, John Doe. And then column C is Mary Doe. And then column A is the total amounts. So for all line items, the amount in column A should equal the sum of columns B and C. So what the instructions will tell you, which you can find, by the way, at the bottom of this form, they're fairly repetitive. So in my article, we try to break out a little bit more detail than saying the same thing on 12 different lines. So, but basically what they say is you should put the aggregate amount, report each item separately. So you see that we have 2 different items for interest income, and then you put in column A first, and then you fill out B and C based on whether or not this is a separate item or whether it's community property, and you split it. So in the case of John's wages, he works for Acme Enterprises. He received $100,000 as reported on his Form W-2. So that's split 50-50, as you can see here. It could also be issued on Form W-2C if you needed a corrected form. So every form and schedule that I mentioned in this video, we'll put links to resources, whether it's an article and or video for each of those tax forms that we've covered. We'll put that links to those in the show notes. So for item 2, the IRS says that interest income tax treatment depends on whether or not the source of that income was considered to be community property or separate property. So at the top of this is John's bank account that he had separately filled with cash prior to their marriage. So this is his separate interest income. Below that, we have a joint bank account with $100, so that's split evenly between the 2 of them. Dividends kind of operate the same way. By the way, interest income, you'll see this when it's reported to you on IRS Form 1099-INT. Dividends are reported on Form 1099-DIV. And in this case, Mary received a 1099 for her ABC stock, so that's allocated to her. And then their joint investment account reported dividends, which they split evenly. Now we go to state income tax refund. So this is a little bit harder one to nail, but I couldn't find anything in the form instructions or publication 555 that states exactly how a state income tax refund would be treated. I would make this a note that generally speaking, if you report state taxes paid in 1 year, so let's imagine in 2022 they filed separate returns, but they got a state income tax refund. If they had claimed an itemized deduction on Schedule A, then they received a tax refund the following year. They do have to report that tax refund as additional income on Schedule 1. And the reason why is because even though you paid the state income tax, you took a federal tax deduction out of it. So if you get a refund on the tax that you took a deduction for, you now have to recognize that as income and pay federal income tax on it. Now, we put this in here just as a placeholder. My assumption in this case is that this would be split equally. However, this is a question that you would want to check with your accountant on. And again, if either of you took a itemized deduction, which if one person filing a separate return claims an itemized deduction, then the other spouse has to as well. That's a big consideration for filing joint versus separate returns. So if you claimed an itemized deduction, then you're going to have to recognize this as taxable income. So in line 5, we start discussing self-employment income. Turns out that Mary's self-employment income from her side job is $50,000 according to the community property rules. That is community property for federal income tax purposes. However, there's a different treatment for self-employment tax purposes that we'll get to shortly. Capital gains and losses. Let's just say that they had a joint investment account, $5,000 worth of gains. That would be split down the middle. Pension income. John's pension. So pension income can be treated as community property and it can be treated as separate property. And it really depends on how much time they spend as a married couple, the state that they live in, how long they were together for the period of time that John was earning his pension, So someone that's been married to the same person for 30 years living in California, their pension might be treated as community property, whereas if John had been receiving a pension before he married Mary, and then he may continue to report that separately. But again, that might be subject to state law interpretation, so make sure that you talk with your CPA about that as it pertains to your specific situation. As a general guideline, the longer you've been together and the longer that you've been together in a community property state during the time that one spouse or the other was earning pension benefits, the more likely it is going to be that it's treated as community property and less likely that it's going to be treated as separate property. Rents, royalties, partnerships, estates, and trusts. So really quick, I'm going to go back to some of these. So you calculate, so state income tax refunds would be reported on IRS Form 1099-G. Self-employment income, you would calculate your self-employment tax on Schedule SE. However, you're going to calculate your self-employment income either on Schedule C or Schedule F for farming. Capital gains and losses would be reported to you on IRS Form 1099-B. Pension income generally would be reported on 1099-R. And then we just put a bunch of stuff into line 8. Rents, royalties, partnerships, estates, and trusts. My suspicion is that the reason this is all lumped into one line is because it all flows through to Schedule E, which is the supplemental income form. None of this income is subject to self-employment tax unless you happen to be in the business of, like if you're renting property out and it's actually part of your business, then you may report that on Schedule C. But generally speaking, passive income, royalty income, partnerships, estates, and trusts, all of that passive type income would be reported on Schedule E. You'll see rental property income. So in this case, this was a separately held rental property that John had. He received $10,000 that was reported to him on his 1099-MISC. So he would put that separately. Joint royalties. They have trademark items that they created together, and they split the royalty income down the middle 50-50 because it's community property. So lines 9 and 10, we're going to talk about this self-employment tax and the deductible part. So before we get to the deductible part, I'll talk about line 10. In the form instructions, generally speaking, self-employment tax is attributable for a married couple. It would be attributable to the person who earned it, right? So in this case, even though Mary's $50,000 was split between Mary and John, her self-employment tax is going to her Medicare and her Social Security benefits. So it goes on her record and it's attributable to her, which would mean that she also takes the deductible part of that self-employment tax as a deduction on Schedule 1. So that's how that would work. Now, taxes withheld. Let's just say the taxes withheld on all W-2s and 1099s and everything else came out to $20,000. Each spouse can split that. Taxes paid regardless of how, if John's W-2 had $19,000 taken out of it, then he basically gets credit for $10,000. Mary gets credit for $10,000. And we don't know where the other $1,000 of income would have come from, but each spouse gets to claim that taxes paid. So I'm just double checking right here. So if you and your spouse file separate returns on which each of you reports half the community wages, then so this would be, John reporting half of his $50,000. Then Mary would report the other half of that $100,000. So each person's reporting $50,000. Each person gets to report one half of the taxes paid. Now, when it comes to other items, Social Security benefits reported on Form SSA 1099, unemployment compensation, they could be considered one or the other, community or separate, and it depends on the type of item it is. I put two items in here. We could go on forever, but Mary's IRA deduction. Again, this is going to her IRA, and John might inherit it someday, but it is her IRA, so she gets the deduction related to that IRA contribution. For medical expenses, let's say that they itemized and claimed a total of $20,000 worth of medical bills. In this case, maybe they split those expenses. And again, it does depend. And here are the personal expenses. So if they're paid out of separate funds, then they're deductible by the spouse that paid for them. If they're deducted from community funds, meaning their joint bank account paid for them, then they would both get the credit. So in this case, this is apparently something that was paid for out of their joint account. So one spouse may be able to claim that completely on their own if they decided to have that spouse pay for it with separate money. So we'll wrap this video up with a brief kind of overview of the difference between joint and separate income tax returns. So we'll scroll to the top of the form and just stop scrolling. But the first thing is that if one spouse, in a separate return, if one spouse itemizes, the other spouse has to itemize as well, or both spouses can split the standard deduction. There's also either a limitation or a complete elimination of certain tax credits and benefits. So generally speaking, separate couples filing a separate return cannot claim the child and dependent care credit on IRS Form 2441. They cannot claim the earned income credit on Schedule EIC. They cannot claim the credit for the elderly on Schedule R. There's a significant limitation on they cannot claim education credits on IRS Form 8863. There's a limitation on adoption credits, which you would claim on IRS Form 8839. You cannot exclude savings bond interest income, even if you use that savings bond for higher education purposes. Normally, you would file that on IRS Form 8815 if you wanted to exclude that interest income for federal tax purposes. You cannot deduct student loan interest that might have been reported to you on Form 1098-E, and you can't take the child tax credit or the credit for other dependents on Schedule 8812. So there are a couple of those tax benefits where you may be able to claim them under very extenuating circumstances. As a general rule, most taxpayers filing a separate return would be ineligible for the vast majority of those credits or deductions. So that's all we have for this tax form overview. We've written an article about it, which you can find the link to in our show notes. Or you can go to teachmepersonalfinance.com, type in IRS Form 8958, and you'll see our article appear. If you like our articles, please subscribe to our newsletter. And if you like our YouTube videos, please subscribe to our YouTube channel. And if you have any questions, comments, or if there's a topic that you would like to see discussed in an upcoming video, please don't hesitate to hit me up in the comments section. Thank you very much and have a great day.